gold is now bigger than the stock market. So I think as gold rises, I think investors are wondering, do they really want to use stocks as a store of value if they can just be buying gold? Bull markets don't die of old age, they get murdered by the Fed. So every year the market does get a little more relatively expensive, even if earnings are good. But this year is pretty unique. Earnings growth is accelerating. The ISM is back above 50 after spending basically 3 years below 50. We have a new Fed that ultimately I think the market is concluding is dovish, and David Einhorn actually believes he's dovish.
Tom Lee's macro framework begins with a simple observation. Investors are navigating one of the most confusing environments in recent memory. The price action is violent, the macro signals are mixed, and traditional relationships between jobs, yields, inflation, and risk assets are not behaving in clean, linear ways. The recent jobs report came in stronger than expected. In isolation, that is positive for growth, but potentially restrictive for monetary easing. Yields ticked up. Expectations for immediate rate cuts softened. Markets were forced to reassess. Before we go on, please take a moment to like this video, subscribe to the channel, and turn on post notifications for more content like this. Every action helps with the YouTube algorithm and greatly supports the channel's growth. Thanks for your support and enjoy the video.
So what do you make of the price action today? This was a undoubtedly better than expected jobs report. Yields ticked up, maybe expectations of cuts by the Fed ticked down. We're trying to just figure it all out today?
Yes, I think the macro is a little confusing for investors at the moment because we not only have a new Fed chair that's announced and his policy stance isn't clear, but I think investors have been thinking AI was going to eat the jobs market, but we have a pretty decent jobs report. I think it's going to put a lot of weight, and we of course had a weak retail sales, but it's going to put a lot of weight on Friday's CPI report, because if that comes in tame, at least the market can understand that the inflation part of the Fed's equation is cooling. And of course, now if the job market is showing decent strength, it kind of relieves us from a macro perspective, because at least we're not seeing an economic downturn.
How about the fact that the market's been a little frazzled? That's the word I've been using today lately. Bespoke points it out. For the first time in history, the S&P went from overbought to oversold back to overbought in a week or less. Goldman's Tony Pasquarello, Tom, says he can't recall a time that was this noisy, this high velocity, this wide open. What about you?
It's very confusing, Scott. I think that there's two things happening, but I think one is really the bigger effect. I think the smaller effect is that AI, as you know, has gone from being this sort of driver of S&P earnings. Now the market questioning, is AI just wrecking tech so badly that it's bad for the stock market? And also, they're not buying the data centers and hyperscalers anymore. They're actually trying to buy the bullets, not the armies. But I think the bigger effect is that gold has become like this singular monolithic trade that's worked. But gold now is a $40 trillion market. X the Mag 7, the S&P's $40 trillion. Gold is now bigger than the stock market. So I think as gold rises, I think investors are wondering, do they really want to use stocks as a store of value if they can just be buying gold?
Man, I just feel like we're kind of going down the line of the AI shooting gallery. And first you take down some of the mega caps, and then you take down a lot of software, and then you take down some of the private credit names, and then you take down some of the financial data related names. Is that just how it's going to be? We're just trying to guess on who's going to be disrupted the most?
Well, I do think AI's capabilities, Scott, are showing improvements, maybe, as they say, doubling every 7 months. And now it's going from mediocre to quite good and substituting some jobs. I think that, of course, is rattling markets. But at the end of the day, and this is a half-full perspective, it's kind of proof of productivity. So to me, I think what we're seeing is that there is a payoff coming from AI, because for software companies, for the ones that are actually truly disrupted by AI, that actually is a cost savings for a client. So I think it ultimately is productivity.
Tom, when someone like David Einhorn comes on today and says, quote, "I think this is the most expensive market that we've been in," can you argue with that? I mean, you can say that it's pricey. Others would say, well, it's justified because look at how earnings are beating expectations. How do you parse that out?
Well, I mean, on a relative basis, his statement is correct because, as the late Art Cashin said, bull markets don't die of old age, they get murdered by the Fed. So every year, the market does get a little more relatively expensive, even if earnings are good. But this year is pretty unique. Earnings growth is accelerating. The ISM is back above 50 after spending basically 3 years below 50. We have a new Fed that ultimately I think the market is concluding is dovish, and David Einhorn actually believes he's dovish. So that's supportive of multiples going up at a time when the stock market has been shown six black swans, from all the way from COVID to the tariff disruptions, and still grew earnings. So I think the market's going to have to start to give a higher PE to the equity market, just in the same way that gold's being re-rated at the moment. Gold's PE multiple, price to sales, I think is over 50 times right now. So if gold can re-rate, I think equities can re-rate higher.
Tom Lee's message is not one of complacency. It is one of calibrated optimism. Yes, markets are noisy. Yes, valuations are elevated. Yes, AI disruption introduces uncertainty. And yes, gold's meteoric rise is forcing a reassessment of what constitutes a safe store of value. But beneath the volatility lies a set of supportive macro forces: accelerating earnings, re-expanding manufacturing activity, a resilient labor market, and the prospect of a dovish or at least flexible Federal Reserve.
I think the important thing to recognize with Bitcoin is that this is it has been and it continues to be a very much cyclical thing. Historically, Bitcoin has topped in the fourth quarter of post-halving years. This is what historically happens. Q4 of 2013, Q4 of 2017, Q4 of 2021, and Q4 of 2025. Now, every single time that Bitcoin has topped, we could find narrative to support it. In some cycles, the narrative could be there was too much speculation in the altcoin market, and therefore it warranted a correction. Back in 2017, think back to the ICO boom. In 2021, we had a pretty long season where altcoins were outperforming Bitcoin, and you could justify that one of the reasons for the bear market was to wipe out all the bad actors in the space, the ones that were not really doing business the right way. You know who I'm talking about. And then in 2025, right, the narrative's completely different because it's not like there was a massive rotation into altcoins. It's not like there's been as much egregious stuff. It's just that this time people just stopped caring. And this is something that I've talked about a lot. If you look at, say, the social risk in the cryptoverse and you color code Bitcoin by the social interest, there's just not a lot of people here. And so, like, the reason for why Bitcoin is dropping, if you need one, I don't really think you need one because it always tops in the fourth quarter of the post-halving year. But if you truly needed a reason, the reason could just simply be that no one cares. The bid has been taken away for a little while. Now, that might sound scary, but as I've said before, the same thing actually happened in 2019. We topped on apathy. The only difference is that back then, it did not correspond to the end of a 4-year cycle, but we still topped on apathy nevertheless. It corresponded to an end of quantitative tightening, and then we just simply waited until much looser monetary policy came. And this cycle, that much looser monetary policy just has not arrived. And I do not think it's going to arrive in the short term. I told you guys last year to expect Bitcoin to stay bearish for the first half of 2026, primarily due to a lot of macro headwinds and also, of course, the 4-year cycle, right? Like, that's what makes the most amount of sense. It's not always a popular narrative, and I know that people would prefer the super cycle and all that other stuff, but you could argue it's kind of a beautiful thing that Bitcoin does this every 4 years because it's a way for the asset class to reset It's a way for everyone to focus on what matters. And so in the short term, you know, if you look at Bitcoin price action, it's been relatively lackluster. Now, a lot of times what happens is that Bitcoin drops into February 2018. It wasn't exactly like this in 2022, but there was a drop here into February. And then in 2014, there was also a drop into February. So what you'll find is that in the bear market, February tends to be a time when Bitcoin, it drops into February. This is something we've seen happen many times. And in fact, you could argue it's happened to some degree every single cycle. What happens after it is that Bitcoin finds a local high in March. So you can see a local high in early March 2014, a local high in early March of 2018, and then a local high in March right here of 2022. So the unfortunate part is that this current move by Bitcoin is looking less like 2018 and maybe more like 2014, or more like what you saw in May of 2022, which you could also argue is a relevant comparison, especially when you look at the market like this. If you look at the market like this, what you could argue is that what if Bitcoin is just simply right here, if you want to compare to 2022? Because in that case, what happened, there was a long wick down, and then after that, Bitcoin slowly bled, and then a few weeks later, there was a spike upwards to draw people back in, and then the market dropped again. Now, if that were to happen over here, what it could look like would be a short drawdown, a spike into early March, and then another drop going into April and May. You'll notice that there's been plenty of times where Bitcoin in midterm years is very weak going into the months of April and May. So there's weakness in February and then April and May. So you'll see that right here, right? February, then the next low was in April. And then in 2018, it was not a lower low, but there was weakness in April, going into April. Before, I mean, the weakness started in early March, but I'm just saying the next low was formed in April. And in 2022, it ended up being a little bit later, right? But I mean, you had weakness into February, local high in March, and then a low in May. So April, May, and then there was another low in June, which we've also seen a lot, right? Even in 2018, there was another low in June. In 2014, there was another low a little bit later in the summer, right? Maybe going into the early fall. But it very much is a cyclical thing where February tends to be very, very weak. And then there's a little bit of renewed interest going into March, and then more weakness again in April, May going into the summer. And then the only question is after the summer, do you see any more weakness beyond that? Because there are times where you get a final drop in the fourth quarter. Now, that doesn't mean we have to. We might not get that, but that is just how it is historically played out. So that is my best guess as to how this is playing out. Bitcoin went down to 60K already, which is essentially the same level, just 1/10 back in 2018. It was 6K instead of 60K. In 2019, it also corresponded roughly to around 6K. And that was after a 50% drop. So when you look at this market, I think what it makes sense to say is that this is the bear market resistance band until proven otherwise. And otherwise will likely be proven, but more than likely it won't be durably proven until later this year. Could you have a moment where we get back above it briefly, like what happened in 2022, like what happened in 2018? Yeah, that's possible. But in order to durably get above it, I think it's probably going to take until, more than likely, it'll probably take until 2027. Now, right now, the bull market support band is actually quite a bit higher than current prices. It's currently around 90,000 to 94,000. So it's going to take some time for that to come down. In fact, in 2018, after Bitcoin had that February low, Bitcoin then just kind of bounced back and forth between the bull market support band until the bull market support band squeezed Bitcoin into making a decision between the prior support at 6K and the bull market support band or bear market resistance band, and Bitcoin chose down. Even in 2022, right after this massive drop, Bitcoin went sideways for a while until the bear market resistance band caught up, and then it forced it to make a decision, and then Bitcoin chose down. So it's a very common thing, and you'll see it happen many times where Bitcoin will just kind of go sideways, slightly bullish bias into the bear market resistance band until it makes the Bitcoin decide, and then it goes down. So that, I think, is how this is playing out right now. There's all sorts of narratives and whatnot, but I think that's the cleanest view of this market.
Benjamin Cowen frames Bitcoin's market not as chaotic, but as cyclical and structured. Peaks and troughs recur on a 4-year rhythm. Intra-year patterns follow predictable trends, and narratives emerge after price action rather than before. February, March, April, and May represent recurring phases of weakness, temporary recoveries, and secondary declines.